Facebook earnings are out. The stock's up 14% pre-market. Does this change everything for Facebook? Do I own the stock? And do I think it's a buy after these results? Let's go. This entire channel is about my journey to build a $10,000 to $1 million real money portfolio. I'm sharing my portfolio, my positions, and my research and how I think about companies. We see Facebook topped estimates with GAAP earnings and they miss on revenue. They had Q1 GAAP EPS, earnings per share of $2.72, which beat estimates by 17 cents. That's great. Revenue was $27.9 billion, up 6% year over year, and they actually missed by $310 million. So they beat on earnings, missed on revenue. Obviously, the street was kind of expecting that. Investors were kind of expecting that. We see pre-market, the stock is up 14%. It's been hit so hard, and expectations are so low that even with a mixed quarter like this, Wall Street seems to like those results. Family daily active people, which is just across the family of applications that Facebook owns. That's Messenger, Instagram, WhatsApp, Facebook, was 2.87 billion for March of 2022, up 6% year over year. They're still growing off of that massive audience of 2.87 billion people. Family monthly active people were 3.6 billion, up again 6% year over year. Even Facebook alone, their daily active users are up 4% year over year, almost to 2 billion daily actives. And then on a monthly basis, almost to 3 billion actives, up 3% year over year just for Facebook alone. They expect 2022 total expenses to be in the range of 87 to 92 billion. Expenses were a huge concern with Facebook because of how much they're spending on Meta and the VR type stuff. So the fact that they're ratcheting those expectations down a little bit kind of shows, hey, management realized that they probably overestimated just to get all the bad news out. And now as they start to figure out and optimize, they're reining that in a little bit. And that's probably mostly what the positive reaction to the results are, is Wall Street and investors realizing, all right, they're going to be a little bit more conservative with their spend than what we were initially modeling for, which is kind of how, Wall Street reacts on a short-term basis. And here we go. This is exactly what we were talking about. Several analysts remarked that Meta Platforms, who calls it Meta? It's Facebook, come on, is showing some restraint in spending, particularly surrounding the metaverse, as the company cut operating expense guidance to be between 87 billion and 92 billion, down from prior outlook of 90 to 95. It's exactly what I said just before. Zuckerberg hammered home that long-term profitable growth is important. Thanks, Mark. We view the action and the statement together as a sign that management is carefully weighing investment levels against the health of the business and macro. It's what you would hope that any management does. Again, Wall Street tends to way overreact and then correct over time, and it seems like that's what happened. They said Facebook's unmatched scale and targeting versus social peers remains a competitive advantage and keeps us at outperform, but will need to show meaningful improvement to the various headwinds upcoming if the stock is going to more sustainably work. The theme that we see from analysts is mixed. They see more potential pain in revenue and earnings. They're happy that they're reining in spending a little bit, and they just seem to think that estimates and expectations are so low that even with these a little bit lowered revenue and earnings estimations, the stock can still do very well from here simply on a multiple or valuation basis. Let's jump into fast graphs and get a high-level overview of how Facebook's multiple currently looks compared to its historical multiple and the growth expectations moving forward. And this will start to give us an idea of, hey, is this stock undervalued? Is it overvalued? And it helps me make my decision as to whether or not I want to own this company in my portfolio, which I'll share at the end of this if I'm going to be buying shares. We're looking at adjusted operating earnings, which essentially is the EPS number that we see in the earnings headline. Facebook is currently trading at a blended price to earnings ratio of 13. It'll be a little bit higher than that because the shares are up, 14, 15%. This is from the share price of 175. Since 2011, they have grown operating earnings at 31% per year. This orange line represents a PE of 31. The blue line represents Facebook's normalized PE ratio over this entire period. So on average, it's traded at a PE of 35. We can see that Since 2016, it's actually been below its average PE ratio. And if we jump down to their EPS growth, it's pretty obvious as to why. 2013, they grew earnings per share 66%. 2014, 101%. 2015, 29%. And back then, it was trading at a PE of 46. Super fast earnings growth. It got an elevated price to earnings ratio. 2016, earnings per share growth of 86%. And this was the first time really that we saw Facebook dip kind of below that blue line, that average, into the, the orange territory. What we're seeing is, guidance probably came down a little bit, and following that, earnings growth started to slow from this incredible rate to still an impressive rate, but just slower, which means that it's going to trade most likely at a lower price to earnings multiple because it's not growing as fast. So in 2017, 46% EPS growth, 23% in 2018. There was a lot of controversy around the business at this time, a lot of negative headlines. I did a video about Facebook before. It was really, compared to now, the time that I remember sentiment being the worst around Facebook. In 2019, they had negative earnings growth. COVID came around, which was actually positive for the business because of their scale and because of the digital move that COVID kind of forced. 57% earnings per share growth, 36% in 2021. And now it's estimated for 2022 to be negative 12%. And then grow 19% and 17%. So yes, it's trading at a lower price to earnings multiple. But in my opinion, it doesn't deserve to trade at the same multiple that it had before because they're not going to grow earnings as fast as they previously did. But the question is, has the stock traded down far enough to where it's just a screaming buy, because even with slower earnings growth, it's going to get back up to some type of multiple where we can get a great return? Well, if it returns to a price to earnings ratio of 30 by 12/31/2024, you're looking at an annualized return of 50%. That would be amazing, but I don't think it's realistic to think that way. How I think about Facebook, I don't think the company is going to completely fail and crumble, but I think just because of the confusion and because of all of these unknowns with Meta, it's gonna be a volatile company over the short term. But the opportunity is, if we believe in Facebook and we believe in the execution, we believe in the metaverse, now could be an extremely good time to be buying shares. It's a tough one. I think a more realistic way to think about valuing Facebook in the future would be to look at its expected earnings growth rate over the next few years. So forecasted, they're looking at negative earnings growth rate, negative 12% next year, or for the remainder of this year, 19% in 2023, and 16% in 2024. And so if we kind of take the average of these 2 years, 19 and 16%, we land, somewhere around an 18% annualized earnings growth. I think that would deserve, if they are effective with that and if they can hit that, which I think is possible, I think it's realistic to think about Facebook trading somewhere between a price to earnings multiple of 15, which would be a 15% annualized return between now and December 2024 for a 44% total return. And, even up to, say, a price to earnings ratio of 21, which if it gets up to there, that's a fantastic return, a 30% annualized return for a 101% total return over the next, roughly 2.5 years. The question is, do I own Facebook? And the answer is no. This is the growth bucket of my portfolio. CrowdStrike's my largest position, Tesla's second largest, GitLab, Snowflake, Amazon, and Monday. Just like in the last video I made on Facebook, I'm strongly considering owning shares. The thing I'm struggling with is a lot of fantastic companies that I own in my portfolio have sold off, and I think there's great opportunities there. But I do believe that the best time to invest in companies that are going to be strong long-term and have a history of being strong is when sentiment is the most negative. That's where we're at with Facebook right now. So I'm pulled towards thinking about owning shares. The reason I'm not is because it's just a complicated story right now, and I can't exactly figure it out. The meta part is unknown. I'm not going to force myself to own shares in fear of missing out or FOMO. I'm going to continue to do research, learn, think, look at the companies I own, and decide if I think those are a better opportunity or if adding money to Facebook is a better opportunity than other companies. Subscribe to the channel if you want to be on this journey with me in this research journey, and we'll figure it out together. Let me know if you own Facebook in the comments, and what am I missing? Is it way undervalued right now, and am I crazy for not owning shares? Would love to hear your take. And if you have any requests for companies or earnings you want me to review, drop them in the comments.